Welcome, dear viewers. Thank you for tuning in. If you haven't already, please make sure to hit the subscribe button and ring the bell so you never miss our insightful content designed to make you a smarter investor. Now, let's dive into today's topic. Picture this. A young, enthusiastic investor, let's call him Joe, stumbles upon a hot stock tip from a friend. He's convinced he's found the golden ticket to wealth. Want to make money? Ever pondered over the phrase, time in the market beats timing the market? It appears our friend Joe hadn't. Let's introduce you to Joe, a newbie investor, convinced he could outwit Wall by timing the market. Just like many others, Joe was under the impression he could predict the market's highs and lows, buying when prices were low and selling when they high. Sounds like a fail-safe plan, doesn't it? However, it was far from it. Joe embarked on his investment journey by buying shares that were trending upward, hoping they would maintain their ascent. But as the wise old saying goes, what ascends must descend. And descend they did. Joe was taken aback as he watched his investments nosedive, chipping away at his capital. But Joe didn't lose heart. He altered his strategy, opting to buy shares that were on a downward trend, hoping they would bounce back. Sadly, he learned the painful truth that a plummeting knife can leave deep wounds. This is the treacherous trap of market timing. It involves high-stakes game of forecasting future market trends. Even though it may appear alluring to buy at the lowest point and sell at the peak, the truth is that even the most experienced investors often fail. The market is driven by a myriad of elements, from global financial patterns and geopolitical occurrences to corporate earnings and interest rates. It's an intricate network that is virtually impossible to predict accurately. So what became of Joe? Well, he took away an invaluable lesson. He discovered that his attempts to time the market were not only nerve-wracking but were also eroding his investment returns. And this brings us to an essential point. Successful investing isn't about impeccable timing. It's about time. It's about a steady investment approach over a prolonged period. It's about weathering the market's highs and lows, letting your money grow over time. So the next time you're tempted to try your hand at the timing game, remember Joe's story. That the stock market isn't a scheme to get rich quickly. It's a tool for accumulating wealth over time. Remember, wealth doesn't accumulate overnight. It's all about long-term investing. Joe, still undeterred, decides to invest all his money in tech stocks. After all, they've been doing well, right? Now let's imagine the tech sector as a golden goose laying one shiny egg after another. Joe, our fearless investor, is thrilled. His portfolio is growing and everything seems perfect. But then, the unthinkable happens. The tech industry hits a rough patch. That golden goose, it's not feeling so well. Suddenly those shiny eggs are nowhere in sight. This is a classic case of putting all your eggs in one basket, or in Joe's case, betting everything on the golden goose of tech stocks. With the tech sector crashing, Joe's portfolio takes a nosedive. His once flourishing investment shrinks, leaving him with less than what he started with. It's a tough pill to swallow. This brings us to the crux of the matter. Diversification. Diversification is like a safety net for your investments. It's a strategy that involves spreading your investments across various sectors, asset classes, and geographical regions. The goal here is to mitigate risks and potentially enhance returns. Think of it as a buffet. You wouldn't fill your plate with just one type of food, would you? In the same way, a well-diversified portfolio is a mix of different investments. It provides a balance, ensuring that a downturn in one sector doesn't wipe out your entire investment. Now let's revisit Joe. Had he diversified his portfolio, his losses in the tech sector could have been offset by gains in other sectors or asset classes. His golden goose may have stopped laying eggs, but he would still have other birds in his coop, so to speak. The moral of the story? Don't put all your eggs in one basket, or in this case, don't invest all your money in one sector. Diversification is not just a buzzword, it's a critical component of successful investing. Spread your eggs in different baskets, folks. That's the key to risk management. Joe, now a bit shaken, starts making investment decisions based on his emotions. He buys when he's feeling optimistic, and sells when he's scared. Now let's dive into this emotional roller coaster that Joe has unwittingly boarded. You see, Joe's emotions are now driving his investment decisions, rather than sound financial principles. He's on a dangerous path, and it's all too common in the world of investing. When the market is on an upswing, Joe is brimming with optimism. This positivity convinces him that every investment he makes will turn to gold. He starts buying left and right, not because of solid research or a well-thought-out strategy, but simply because he's feeling good about the market. But then, the market takes a downturn. Suddenly, Joe's optimism evaporates, replaced by fear. He sees his investments losing value and panic sets in. In his fear, he starts selling off his investments, trying to minimize his losses. This behavior is a classic example of emotional investing, and it's a one-way ticket to financial disappointment. You see, the market is like a pendulum, it swings back and forth. Buying high out of optimism and selling low out of fear is a surefire way to lose money. What Joe needs to understand is that investing isn't a game of emotions. It's a game of strategy and discipline. It's about making decisions based on thorough research, understanding the risks, and sticking to a plan even when the market gets rocky. Emotions can be a powerful motivator, but they can also be a destructive force when it comes to investing. They can cloud our judgment, lead us to make rash decisions, and ultimately steer us off the path to financial success. So if you find yourself on this emotional roller coaster, it's time to take a step back. Take a deep breath. Remember your strategy. Remember why you're investing in the first place. And most importantly, separate your emotions from your investment decisions. Investing isn't about emotions, it's about strategy and discipline. Joe, now desperate for a win, starts chasing short-term gains, ignoring the long-term potential of his investments. Imagine this, Joe is frantically running around, grabbing at every shiny investment that passes by, hoping it will be his golden ticket. He's like a kid in a candy store, but instead of sweets, it's stocks, bonds, and commodities. He's not looking at the nutritional value, or in this case, the long-term prospects. He just wants something that will give him an instant sugar rush of quick profits. But here's the thing, investing isn't a sprint, it's a marathon. It's not about who can make the most money the fastest, it's about who can keep the pace and make steady progress over time. Short-term gains can be enticing, but they're often fleeting. What looks like a sure bet today could be tomorrow's losing ticket. Joe's focus on the short term means he's missing out on the potential of long-term growth. He's so busy trying to catch the next wave that he's missing the tide. You see, while short-term investing can be exciting, it's like riding a roller coaster. You have the thrilling highs, but you also have the stomach-churning lows. And just like a roller coaster, it can leave you feeling dizzy and disoriented. On the other hand, long-term investing is more like a scenic train ride. It may not have the same adrenaline rush, but it offers a smoother, more predictable journey. And most importantly, it lets you sit back, relax, and enjoy the view. Let's take a step back and look at the bigger picture. The greatest fortunes weren't built overnight. They were built over years, even decades of patient, consistent investing. The likes of Warren Buffett and Charlie Munger didn't make their billions by jumping from one hot stock to another. They did it by sticking to their strategy, even when it seemed like they were missing out on the latest trend. So, let's take a leaf out of their book. Let's stop chasing the quick buck and start thinking about the long game. Let's stop looking for the next big thing and start focusing on the steady, reliable growth that comes from sensible long-term investing. Patience is a virtue, especially in investing. Think long-term. So, after a series of missteps, what has our friend Joe learned? Well, let's dust off Joe's investing journey and see what gold nuggets we can glean from his experiences. Joe's first mistake was being lured by the siren song of a quick buck. Like a moth to a flame, he was drawn to the promise of immediate wealth, without doing his due diligence. Lesson learned. Thorough research is the bedrock of every successful investment. It's not as glamorous as a lottery win, but it's a lot more reliable. Next, Joe fell into the timing trap. He thought he could predict the market's ups and downs with precision. But instead, he was left swinging in the wind, missing out on golden opportunities. The takeaway here? Time in the market beats timing the market. It's impossible to predict with certainty when the market will rise or fall. Consistent investing, however, is a strategy that has stood the test of time. Joe's third faux pas was his one-track portfolio. He put all his eggs in one basket, and when that basket toppled, so did his investments. Diversification is the name of the game here. By spreading investments across different assets, you can cushion the fall when one of them stumbles. The emotional roller coaster was Joe's fourth downfall. He let his feelings dictate his investment decisions, leading to rash actions and regret. The moral of this story? Keep emotions at bay. Investing should be guided by logic and strategy, not by the whims of your heart. Finally, Joe was myopic in his approach, focusing only on short-term gains. He overlooked the power of long-term investing and the magic of compounding. The lesson? Patience is a virtue, especially in investing. Rome wasn't built in a day, and neither is a robust investment portfolio. Investing is a journey, folks, and sometimes learning from our mistakes is the best education we can get. That's it for today's video, folks. We hope you found these investing pitfalls and how to dodge them helpful. Remember, we're all on our own unique investing journeys, and it's crucial to keep learning and adapting. If there's a topic you'd like us to cover next, drop a comment below. We love hearing your thoughts and suggestions. Don't forget to like this video if you found it informative. Your support helps us create more content like this. And remember, subscribe to our channel for more investing tips and tricks. We're here to help you navigate the investing world, one video at a time. Until next time, happy investing.